All right. Hello, everybody, and welcome to the 2025 Q1 Klaas webinar. We are very excited for you all to join us today. My name is Josh Stirling. I am the Chief Investment Officer here at Klaas Financial. Today, I am joined by Kite, who's our CFO, and Eric Schwartz, who's one of our financial planners. We do have to start off the meeting by apologizing. Last week, we had our meeting all set up. All three of us were here, ready to go. And with 1 hour, Zoom went down. So we apologize. We absolutely wanted to have a conversation with everybody, but we had to delay. And fortunately, we were able to reschedule to today. So we've got a lot to cover today. I don't know if anybody's been watching the news, but I think it's been a little active. So we have plenty to talk through today. But we are going to make sure that we have time at the end today to go through plenty of Q&A. So as you're watching this, feel free to put in a question. It's a little Q&A button down at the bottom with a little question mark. So as we go through this, if you have questions on one of the slides that we're going through, or if you have a question that's outside some of the content that we're talking about today, go ahead and put that in and we'll answer it at the end of the presentation today. So some of the topics we're going to be talking through today. First, Eric is going to be talking about the economy, kind of where we're at today. Then, of course, he's going to jump into the tariff discussion. Lots to talk about there. And then after that, I'll be chatting through some of the market volatility that we've been seeing if it's been happening, what the market's been reacting to, where we are year to date. And then Kyle is going to round off the conversation for us today and talk about what this means for long-term investing and how that impacts your portfolio directly. So for those of us who are joining us for the first time, we always like to give a quick intro to Klaas Financial. So we are a financial planning firm. We've been around for coming up on 50 years now. We have two offices, one in Rockford, Illinois, and one in Madison, Wisconsin. Between those two offices, we have 21 employees. And for our clients, we do financial planning, but we also help them invest their assets and help them plan out retirement. And we do also help companies with 401k plans. Right now, we manage about 700 million for those different client types. All right, well, let's jump right into it. Eric, what can you tell us about the economy?
Yeah, so a little bit of an interesting webinar for us today because often we'll look back at the quarter that has passed and talk about what happened there. I think today is going to be a lot more about what's happened since the quarter ended. We've seen a lot of activity, announcements, volatility, all sorts of things going on since the end of the quarter. So we are going to be talking a little bit more about things that are more recent today compared to normally what we would talk about. But let's begin with let's say maybe the more positive news, I guess you could say. Looking at the economy as we sit today. Our real GDP is still positive, and it's actually pretty close to the long-term average when we look at the fundamentals of the economy. Now, you could say that's largely because the impact of tariffs really maybe hasn't been digested yet. But as we sit here today and look back, GDP still is positive for us, and inflation has continued to moderate the last few months. And unemployment remains in a good place. Now, again, all of these things can change pretty quickly. But as we sit here today, if you were to kind of filter out the noise and just look at the fundamentals of the economy, they're not looking too bad, I would say.
Yeah. It's nice to look at today and say we have a good, stable footing. Maybe not as good as it was maybe about 12 months ago, but still within the normal kind of scope of things, good long-term average results, both from unemployment, GDP, inflation finally moderating and whatnot.
Yeah.
Definitely in a better position than what you might be feeling from the news and headlines. Of course, all those are really focusing on what's to come. But
sure,
it's nice to know that we are at a stable position currently.
Yeah, and I think that's a lot of what we're going to be talking about today. You just touched on was sort of where our clients are right now relative to what it is that you're seeing and hearing about. whether it's market returns or the impact of tariffs and costs and things like that. We want to really pull us back here a little bit and get some perspective on where things are. So that brings us to the topic of the day, the month, maybe the year so far. Tariffs. So these have been in the news as the new presidential administration has followed through, we'll say, on what was a big part of the campaign, which was the idea of a more protectionist approach to the economy, right? Looking at implementing tariffs, which we're going to talk about definitionally here in a moment, as a strategy for approaching global trade. So I want to start really, really basic with what a tariff is. I feel like we can get really lost in these discussions because we hear about it in the news or whatever it might be, and it sort of takes on a life of its own. But a tariff is a tool that countries have to help, I guess, manage their global trade. So at its very base, a tariff is a tax that can be imposed on imports coming into the country, which then would theoretically increase the cost of imports, the hope of which being that folks would stop importing and start purchasing or sourcing materials and products from the country, from inside the country rather than importing the materials. Now, the tax is paid by the importer, so whoever is bringing the product into the country, and it's either that cost is either borne by the importer or passed on to consumers or somewhere in between, right?
I think we hear so often that this is literally a tax on American consumers,
Sure.
because that is going to be 100% passed off on. And then you have others talking about how it's just going to be gobbled up by those that are going to be exporting their goods, and we're going to be importing here. And a lot of times it really comes somewhere in between and a mix of it all. Different types of productions, different types of goods that are coming over are going to be handled differently. Some are going to take them on completely because they have high profit margins, and others are going to pass off the cost 100%. But there's this whole world of in between that is kind of the reality of letting tariffs kind of sink in over time, especially in a time when it's pretty volatile on what's going to stick and what's not. A lot of it is really going to be a sit and wait and see.
Yeah.
Of course, probably will have some level of inflationary aspect to American consumers. At what level? It's really going to take a lot of time to see how that plays out.
And what you're hitting on right now is the reason the market is reacting so strongly to this, and it's uncertainty, right? It's the market is trades based on the expectations of future profits of corporations, and whenever there's anything kind of thrown into any kind of wrench thrown into that process, there's always concern and increased volatility, and we have certainly seen that here. And I think because we are so sensitive right now as well, the market and consumers to inflation, something that has the ability or the potential to cause inflation is very, very concerning. It also is concerning from the aspect of if there are additional costs, for example, tariffs for companies that are importing goods, well, that could theoretically mean lower profits, right? So if corporate profits are lower, then the market is going to reprice based on those expected lower profits. So all of this to say, it has created a ton of uncertainty, and that is really what the market is responding to. And I want to just do a brief kind of timeline of the original implementation of the or announcement, we could say, of the tariffs. So back in February, we heard the sort of initial plans for tariffs on China. Late February, and then into early March, we started to hear about plans for tariffs against Mexico and Canada. And as we sort of digested that information, there was some additional news that came out about delaying tariffs and maybe reducing them. And that brought us to April 2nd with the announce of the announcement of what were called the reciprocal tariffs, which are on the screen here. And that was essentially blanket tariffs on most of the countries in the world. And the market responded really, really strongly to that. Between the announcement and April the 8th, the S&P lost 12% of its value. So that was very rapid decline in the market. Obviously, that was part of the reason that I think folks responded to it so strongly, is that it didn't take long to get there. April 9th was the announcement of the 90-day pause on implementation of, again, what was called the reciprocal tariffs. And the market responded very strongly to that. The S&P rallied just that day alone 9.5% into the close that day. So really, really strong responses. And we've continued to see, I would say, heightened volatility since then. But really what it all comes down to, like I said earlier, it's about uncertainty.
All right. Well, let's move on to what actually happened in the market. We've got two slides to look at here. So this first slide that we're going to look at here is really looking at the volatility in the overall market, because I mean I can say pretty confidently that all of us have heard nonstop the extreme volatility in the markets all throughout the year. But have we actually seen some of that volatility that has been supposedly talked about so much? And honestly, we do have to kind of sympathize here because it's rough seeing these messages come into the headlines, what seemingly every other day or multiple times a day, going from down 2% on a day to up 3% in the exact same day, and then down 1% by the end of the day. It's rough to get some of those push notifications if you're one that's watching this pretty frequently. But let's take a look at the actual data that we have here. So on the screen right here, we're looking at the kind of the magnitude of the returns. We're looking at the absolute value of returns. So if the S&P 500 was up more than 1% or down more than -1% or less than -1%, we are looking at that and we're counting those number of days that we've seen so far throughout the year. This data is up through as of yesterday's close. So we are looking at the volatility that we've seen since the end of the quarter, since March 31st, because that's when we've seen some of the biggest shifts. But notice here that the data that we're looking at, because everybody always talks about the volatility on the downside, we're talking about the returns both negative and positive. Because as hopefully most people know, we had the 8th biggest day in the S&P 500 on record back maybe about a week and a half ago, 9.2% in one day for the S&P 500. But enough of that. So what we're looking at here, if we look at the column listed as 2025, as we go down more than 1%, more than 2%, more than 3%, more than 4%, we can see that those numbers get tighter and tighter because days with swings greater than or less than +4%, -4% are relatively infrequent. However, when we look at that, we say, well, let's look back across the last 24, 25 years. Are we above average? Are we hitting the average, or are we below average? And the actual number of days that we typically see, yes, we're slightly above the average, but we're not that far off. When we're looking at the number of days that we've hit more or less than +4, -4, right now we're sitting at 3 days throughout the year so far for the S&P 500. The yearly average up until April 23rd, all the way back to 2001, is about 1.4. So yeah, we're about double the days on those really big volatile days. But when you go back down to the ±1%, 32, 23 in the relative location of number of days, certainly more volatility than we have seen historically, but it's not a blockbuster year on unbelievable volatility that's completely unstomachable. A lot of this is really pushed by the headlines that we see every day. What really matters is, well, where's it at the end of the day? But not only that, but none of our clients are only invested in the S&P 500.
Right.
That would be ill-advised, especially in years like this. Um, Most of our clients end up with a diversified portfolio. Our most common one is 60% equity, 40% bonds. That's why we typically show it on these slides here. But when we compare the number of days of extreme volatilities compared to the S&P 500, we are sharply, sharply down compared to the S&P 500 in terms of that big swing left and right. We have not had one day where a 60-40 portfolio has been above 4% or lower than negative 4%, which is a great thing. That's the purpose of the portfolio. That's the design of it, is to help smooth out the ride when everything you're hearing in the headlines is the NASDAQ's down 13%, hold on for dear life, your 401k is going down. No, that's not the way that you invest. And that's not the way that we advise our clients to invest. So know that while you're seeing the headlines, they're certainly scary. We're trying to concentrate on the numbers and the experience that our clients are actually seeing.
Yeah, it's a difference between, I mean, it's true, the S&P 500 and NASDAQ year to date are down quite a bit. But when it comes to what your portfolio has actually done, you invest in far more than just those things. And I believe that's what you're going to be getting into here.
Yeah, because these numbers are nice and helpful to see the volatility, but we really care about the returns. Let's look at what the money actually plays out to be. So on here we have 5 different indices and portfolios to look at. So over on the left we have the U.S. Bloomberg Aggregate Bond Index. Then next to it we have our 60-40 bond portfolio. Then we have what's called the MSCI ACWI ex-US. It's basically the global stock market minus the US. We have the S&P 500 next to that, and then the NASDAQ, which is big tech index. And so we're looking here at one year-to-date performance, and that's all the bars that you see with all the numbers right next to them across the board. And then we have the lowest point on the year so far, and that is notated by the red line. And so the indices that we've been seeing in the headlines left and right have been the S&P 500 and the NASDAQ. And you can see that, yeah, those are down, and they're down quite negative. The S&P 500, as of yesterday's close, is still down 8%. The NASDAQ is still down 13%. And at worst, we saw the NASDAQ down negative 21%. That's bear territory. That's down quite a bit. Now, it isn't unheard of. These things happen pretty naturally. But the point that we're trying to show here is that that blue bar, the 60-40 portfolio, is only down 1% as of yesterday's close. And at worst, it was down 6%. So while those are not great to experience and it's not ideal, they happen pretty naturally. And what the headlines are showing us is not actually what's happening inside most individuals' portfolios.
Yeah, and I think you look at it and you say, okay, well, what's going on in that 60-40 portfolio? Why is it only down 1% when these other stock indexes, frankly, the ones we talk about and hear about the most, are down so much, right? It's, well, you have bond exposure, which is that far left bar, which you can see is up about 2% year to date. And you have international stocks, which is that middle bar, the MSCI ACWI ex-US. That's up 7% year to date, right? So when you mix those things in with exposure to those indexes on the far right as well, that's where you can see that diversified portfolio holding its value much better year to date than the US stock indexes has.
And that's kind of the point of the whole thing, is stability, smoothing out the ride. You might hear some advice that's given out to younger investors: hold QQQ and hold on for dear life, because it's not an easy ride. It goes up and down. And I mean, if you look at a 20, 30-year time span, oh, of course, slam dunk, like the NASDAQ has seriously outperformed. However, that's not an ideal experience for most people when you go into a potential recession or the markets have a negative reaction to things like tariffs, and all of a sudden down 20%. We try to design portfolios that can weather most storms, have ample diversification, And so far this year, we've seen that exactly play out the way that we intend to. All right, Kyle, can you talk to us about more long-term investing rather than just year to
Yeah,
date?
absolutely. I absolutely love this slide. I'm glad we finally pulled it together because it just illustrates so well why we tell clients that you have to stay invested. You cannot make decisions day to day. So what we're showing here is a growth of a $10,000 portfolio on the far left and what that grows to if you miss out on certain days of the market, of good days. But the first thing to focus on is what's in that little text box there. 80% of the 30 best days in the market are preceded by one of the 30 worst days in the market within 15 days. So what's that saying? And this is over the last 35 years, give or take. So to get to those 30 best days, you have to ride through one of those 30 worst days, and it usually doesn't take very long for it to happen. So think of this. You have a really bad day, which we've seen a microcosm of this a few weeks ago as we were just talking about. The market got absolutely hammered over 2 days. But then the best day, one of the eighth best day in the S&P's history, happened that very next day, right? So you just have to ride through those types of things. And again, it usually comes within 2 weeks, 15 days basically. So basically 2 weeks, you're going to get one of those really nice days that you have to hold on for. So this is why when it feels like the sky's falling and the market's going down 1,000, 2,000 points for a couple days in a row, you feel like the world's ending. You've just got to ride through those types of things. So with that out of the way, let's look at some of these bar charts that we're looking at. So that $10,000 portfolio, if you would have just stayed invested, never moved your money out or anything like that over the last 30 something years, 34 years, your $10,000 would be worth $340,000. So go one bar to the right. If you missed the single best day over those 34 years, you would have only grown it up to 304,000, which is $36,000 less, give or take. By missing one single day over 34 years, you move your annualized return, which is all the way down there in the bottom. You see it goes from 10.6 to 10.3. So missing one day and out of 30 can move your annual average return by 0.3% or close to 0.5%. And then it just gets more exaggerated. Even the 5 best days out of those 30 years, you can see you go from the 340 down to the 214, almost 215. But again, look at that average annualized return goes down by almost 1.5% by missing just 5 of those best days over those 30 years. And then, like I said, it just gets more and more exaggerated as you go down here. So this is why we say it is absolutely so important, as I said, to just stay invested and ride through these things. And this is why diversification is actually working this year. And this is why we've believed in it for so long. As you've seen on that last slide, this is the first time in a long time that international has been outperforming the US. For the last 20 something years, it's just been just by the S&P 500 because the international is not outperforming that. Well, you can see the benefits of it in a year like this. And that's what makes these rough times easier to ride through, is because we are trying to curb those waves, just like we mentioned. All right, so this takes to the headlines. So again, there's always a reason to sell. These are some of the most common, I guess I would say most memorable headlines over the last, again, going back 30 plus years here, back to 1990. So obviously you can see just different things going on. The hurricanes, the US government shut down, all those types of things on the left there. That's what the line's showing. But what I want to focus on is these bar charts on the right. So these annualized returns investing before historic downturns. So that means that even if you knew these things were coming and you picked the worst day to invest, like let's take the first bar chart, the dot-com bubble burst, that was in the 99 to 2000 range. You could have picked the worst day before that bust happened. And if you would have just stayed invested and rode through it, you still would have been up 8% per year since that dot-com bust, which again was roughly 25 years ago, give or take. Then you've got the global financial crisis. That is the one that most of the people on this call are going to remember. That was 2008 and 2009 with the housing market blowing up and all that kind of stuff. That was the second worst crisis we've had since it's the second worst one. The only one worse than that was the Depression, which most people don't remember the Depression because we weren't alive back then. But even again, same thing. If you were invested knowing that that was coming, you could still be averaging 10.4% if you would have just ridden through it and then obviously stayed invested up through now. So again, this is why the market goes up and to the right over the long term, even though there's a million things in headlines every single week, every single year that thinks, oh no, this is going to be different, right? So that's why you hear us say all the time that we've got 100 years worth of stock market data. And is there something so outlandish? We've been through multiple world wars. We've been through great depressions. We've been through a housing crisis blow up. What is going to happen that's so much worse than what we've already been through? Of course, anything's possible. I'm not saying that it's never going to happen, but to think that it can be that much worse than what we've already gone through, it's hard to see that. So.
Well, I think one of the key things that I'd love to have Kyle, your take, or Eric, your take on this is just this information is so helpful to see and to see it laid out like this. But we were chatting with another advisor earlier today, and it really is difficult to talk about these things when emotions are taking over. And I think that's a completely fair thing to talk about when you're hearing all these things happening. There's complete uncertainty in the market, and the market is down 10% or 20%.
Yeah.
I mean, how do you all handle that conversation where there's absolute legit rationale for wanting to panic and say, I'm out? I mean, what's both of your responses to something like that?
Kyle, you want to go first, or you want me to go?
I can go first. Yeah. So
Okay.
there's as human beings, as you mentioned, Josh, we are very emotional creatures, right? And again, if you look at these types of things, if you could say that we had no emotion, you would just buy the S&P 500 and never touch it because it's up 10% a year over the last 100 years, right? But it's been cut in half multiple times. And when our human emotions kick in, that's where holding it through those 50% downturns is very, very tough to do. So that's, again, why we lean on diversification. So it's just important to take a step back and look at the long-term picture, which is the hardest thing to do because we all get in our minds of just getting through the day, right? Especially if you're still working and you got kids, all this kind of stuff going on. Just take a step back and say, okay, I'm not pulling all this money out tomorrow. I still have 20, 30 years left of retirement. I know that over time, I will make a positive return in the stock market, even though we're going to go through some painful points along the way here.
Yeah, I think what I'll add to that is, every time we go through a market downturn, you inevitably get some version of the comment of, well, it's different this time, right? The market's come back before, but it's different this time. It's not going to come back. And every time is different. There's no question about that, right? Every time is different. But the fact of the matter is, if the market were to never come back, that means that all of these, these corporations that we buy the underlying stocks for and we invest in are going to zero and are never recovering, right? So if we can imagine a world where there are no for-profit corporations to invest in, that's the only way the market goes to zero and never comes back. And I think the other piece of it is, we'll often hear from people who are retired, well, I don't have enough time to wait and recover from this. And totally get that concern, but what you need to think about is, I know if you're opening up your statement and you're looking at your account balance, most of the time people are looking at that number in the upper right corner, up, down, sideways, whatever happened to it. You kind of they'll view their account as one number, and it's either up or it's down. And in their minds, it's, well, if it's down, that means that I need to hold, I need to reduce my withdrawal, or I need to, I'm selling while things are low. Our clients have many different holdings within their portfolios, right? And just because one part of the portfolio is down doesn't mean another part won't be up or holding steady, right? We looked at that with the fixed income markets and the international markets, right? So when people are retiring or are retired and taking withdrawals, generally our clients are taking monthly withdrawals. You're breaking off little pieces of that portfolio every month throughout your retirement to fund your expenses, right? Well, you're not selling it all on one day, right? You're not selling every single holding at one time. You have different pieces of that portfolio that are built to, pick up the slack when other parts are not doing as well. So yes, you do have less time to wait for it to recover, but it also doesn't mean that you're holding that your portfolio is all the way down and you've lost everything you've ever gained, right? It feels like it, but it's simply not the reality situation.
And myself and my team, our investment management team here at Klaas, we're some of the ones that help kind of make those decisions about, hey, what is the best thing to sell at this moment? How can we stay within target without selling assets that have just had a recent plummeting? I mean, that's the way we design portfolios, is so that there's diversification among those different types of investments. So if your investment that is focused on the S&P 500 has gone down and you need a distribution coming out, well, that position is not the thing that we reach for first. We look for something else that is much more stable or has gone up in relation to the S&P 500. Well, in addition to that, dividends are a thing. We have income coming off the portfolio to help supplement income. Depending on the portfolio that you're in, current portfolios are yielding anywhere between 2.5% all the way up to about 5.5%, kind of depending on the day right now. But that yield kicks off and helps supplement income. So there's some scenarios where we're legitimately not even selling anything because that income is just producing everything that you need. It's the benefit of having many, many different assets within your portfolio. And that's our responsibility to help kind of navigate that, help determine what's the best practice to do as you need that income throughout retirement. So we hope to make it a little bit easier and make that decision-making process a much more simple thing to just say, yes, don't stop my income. I see that things are going to be stable long term. And we will absolutely be able to supplement income along the way. Thanks for that insight, Eric and Kyle. All right, we'll go ahead and we'll move on to some Q&A here. We've had a couple of good questions come in, but feel free. We've got a few minutes here. We'll go until about 4:45-ish, and we'll chat through a couple of the questions that we have on here. So we did have one of these questions come through before our webinar, so I have a couple of prepared remarks for it. But we do have a question here. There was a recent article that was put out back when Trump reversed his tariffs that he initially brought out. And the article talked about the debt market being the catalyst to the reversal on tariffs. And so I'll briefly talk about that. I wish it was a very, very simple answer, but unfortunately it's not. And it really is focusing on the treasury market and not really corporate debt, not mortgage-backed securities, really just treasury positions was the main focus of it. And so for everybody's kind of knowledge and understanding, U.S. Treasuries are an incredible world force. It has an incredible presence internationally. About 25% of the individuals who own U.S. debt is actually foreign entities. And that can include government entities, corporations, and whatnot, but outside the U.S. bounds. But because of this, this helps cement the US dollar as the world's reserve currency, which is a big, big deal. And it's been the world reserve currency since World War II. This gives us many, many benefits, but it allows us to have lower rates on our US treasuries. It allows us to have tools of diplomacy. It gives us these different benefits that help our economy be really competitive in the global landscape. So our treasury market is incredibly stable, incredibly powerful, and definitely something worth investing in and maintaining. We definitely have it inside our portfolios, of course. But what happened with this? Why was this kind of the catalyst to what happened? And I wouldn't suggest that it is the absolute catalyst that caused Trump to kind of back off some of the tariffs. I think there's a lot of stuff that played into it. So I'm not going to come out and say, hey, this is definitively what happened. I'm sure there was a lot of stuff that came into it, but I'm just going to try and explain what these articles were talking about. So some of these foreign entities had rumblings talking about selling off U.S. treasuries, and that caused a little bit of fear with some other individual holders that held U.S. treasuries. And these aren't typical investors like the portfolios that we have. or common investors, or even many, many corporations. But places think more so like banks or hedge funds or other investment strategists that might be using US Treasuries. They'll use it as a borrowing tool. So something that's not very typical for typical investors, but this caused them to recognize that they have enhanced sensitivity to what happens with US Treasuries. Small movements to them mean a lot to their end balance sheets. And so when foreign entities talked about selling off some of their US assets, would have made minor movements in the market. To us, to our portfolios, that means very, very little. Small movements here or there, but ultimately we get our yield, we get our return. But to those investors that use it as a borrowing tool, like some banks and hedge funds, it can mean a lot. So they came in and they started deleveraging or moving away from that risk that they had on their balance sheets. This caused certain institutions and potentially President Trump at the time to look at it and say, okay, there are some red flags here. Our overall financial plumbing system is incredible and wonderful, but this might have shown a couple of leaks that might be there. And so that is what's talked about as the thing that is kind of the catalyst to the reversal. There's a lot more to this, but from as simple as I can make it, it really came from just the anticipation that foreign entities might sell off some US Treasuries. Kind of leave it at that, but feel free to reach in and ask more questions about that if you have any.
Yeah, I think it was largely a response to yields changing on US Treasuries. So if we think about it at a very basic level, the amount of interest that the US gets charged, right, to borrow money, that rate when it goes up is generally viewed as a penalty that we're paying higher interest, right? Because we are not seen as good of a we're not seen as good for the money as we were before, right? So there was concerns about the U.S. economy and the ability to actually repay these debts to some extent, and it caused, like Josh said, entities to start selling, and when it sells, it lowers the value of things because there's more of them available.
Yeah,
and
increases cost for US when we want to raise money to invest. So has some repercussions, but I mean, as we've seen, the US or the yield out there in the market, we've seen our yield curve come back a little bit to normalization over the past couple of weeks. So things have certainly smoothed out a little bit, but we are still seeing some volatility in the market on this. All right. The next question that we have, I think this is a pretty good
really
question.
Good question.
Yeah. I've been bombarded by Facebook videos talking about the things that rich people do other than 401ks. Also plans to pay no taxes, private equities. Are these real?
Great question. I see these posts as well, and they kind of drive me nuts if I'm being honest, because people love to talk about, well, you're stupid if you're putting money into your 401k. You should be investing in real estate, or you should be, using one of these other really complicated tools. More often than not, they're being put out there as ads to entice you to purchase those types of securities or to put money in real estate. The fact of the matter is that the tax benefits that are inherent in saving in a 401k are far and away more powerful than some out there real estate investment or private equity. The benefits of that are just nothing compared to what the 401k can do from a tax perspective over time. And so, are they real? Yes. Kyle, you want to weigh in a little bit more on this?
No, I think you handled it well. Is the matter of fact is that yes, they are real. There are other options out there for 401ks, but for 95+% of people, just getting people to put money in a 401k on a regular basis and take care of all of that advantages that it offers is a great first step, and one of the biggest steps to get people to do. So yes, there certainly are some exotic investments out there. You've got private equity, as mentioned in the question. There's securities-based lending. There's life insurance that is tried to sold as a investment vehicle because it's tax-free, right? There's all these different things out there. And the reason that again, our focus is on financial planning, good behavioral, down the line, making sure that you're going to be successful as easy as possible. So for most people, the tax benefits, the complexity of these types of things that they're talking about when they're pitching these things is not worth it. And as Eric said, primarily they're pitched by people that would be happy to sell you one of these exotic investment products that, like I said, for 95% of the people, you just need to stay away from those types of things. So.
And I liked one thing that you said specifically, that these are unique, exotic tools that you can use. Yes, they exist, but you can also go to a financial advisor and ask if it's a legitimate thing and if it's something that would be beneficial to your plan. We have many tools at our fingertips. We have eMoney or Klaas Portal, which is our financial planning tool that allows us to do forward projections. We utilize Holistiplan, which allows us to do really, really effective tax forecasting. If we think that there is a tool out there that can be used, that you're presented with, and we can look at it, see how it goes into your financial plan, and if it's better, we can look at that. We don't need to guesstimate. We can come up with real numbers. Just nice having an independent financial advisor that has your back on that kind of stuff. So
last thing I'll add on this is when you're seeing videos and things that are being pitched to you saying that this one thing is the best, and if you're not doing it, you should be very, very doubtful of what you are reading, because everyone's situation is different, and there is no way that this one other type of investment is the best thing for everybody. In our experience, and I'll say even more recently, things I've seen, these often come with very high barriers to entry. They probably charge pretty decent commission that the person selling it to you gets paid. And in many cases, they are what we would call illiquid. So getting your money out is not as simple as calling up and asking for it back. There is a distribution timeline. The money may even be locked up for a certain amount of time. So there's just a lot of complexities around it that make traditional old 401k really, really attractive.
Yep. If anybody wants to spend time talking about private investments, please give me a call. I would love to chat for half hour, 45 minutes. We got plenty of time. All right. We've got time for one more question here. Is it a good time to buy a home for a young person in their mid-30s and take on a 15 or 30-year fixed mortgage?
A great
get this question all the time, right?
We do. Yeah.
We do, yeah. It's very, very poignant right now, especially because the thinking was a couple of years ago was that house prices have gone up so high, and as soon as they start cutting rates, they're going to start coming down, right? But we can see that that's not the case so far. That housing prices have stayed higher while interest rates have risen. But when it comes to a home, especially for somebody in their mid-30s, that's probably, have kids and all that kind of stuff. At the end of the day, you got to have a place to live. So you can't just say, I'm going to keep waiting for the optimal time and let your life pass you by. So the other side of this is that we got kind of spoiled, and we were exposed to artificially low interest rates for a very long time. If you go back and look at the history of interest rates, 6-7% mortgages are not way out of line, right? In the 80s, we had 15 and 20% mortgages, and then we've gotten used to 2 and 3% in the early 2020s and things like that. So at the end of the day, it's much more important to find a good home that you like. Obviously, don't stretch yourself. That's part of this whole houses have become unaffordable is because we've got higher prices and higher interest rates, which means your payments each month are much higher than they would have been 4 or 5 years ago. But it's hard to say that we're due for a housing market crash or anything like that, just because there still isn't a ton of supply out there. And part of that is because many people are locked into 30-year mortgages at 2 and 3%. So why would they sell that house to go buy a bigger house and take on a bigger mortgage, right? And drive up their monthly cost. So the answer is yes, you need a place to live. So don't let interest rates and home prices scare you, because the likelihood that they come down 20, 30% is probably very, very low at this point. So
You're going to live in that house for a while, whether you got in 3 years ago, today, or 2 years from now. If you're living there for a long period of time, it's not going to make much difference in the end, right? As long as you are not just looking at, oh, I'm going to be in this house maybe for a year or two, well, then there's maybe a little bit more concern there. But if you're looking at purchasing a house you're going to live in for a while, it's a lot like getting invested in the market. The exact day that you invest is less important than the amount of time you spend invested or living at home.
All right. Perfect. Thanks, guys. And thank you, everybody, for joining us today. We know it's volatile times, so if you have any questions at all, please reach out to us. We're always available by phone, or if you want to make a special appointment. But we thank you for joining us today, and we will see you again in a few months. Bye.
you guys.